Welcome back to Portfolio, everyone. And in today's video, we are going over 7 stocks you should take a look at this week. All 7 of these companies report their latest earnings this upcoming week. So of course, when companies report earnings, there may be some share price volatility. And when there is some volatility in the market, you may get a nice buying opportunity. So this list this week combines a bunch of dividend payers and growth stocks. There's a lot of variety. And of course, we have companies that actually operate in various sectors of the world. So nice diversity on today's list. Before we break down the list, as you know, I'm the Gen Z investor, and we post videos here every single day about the stock market. We talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe. I want to get right into the first stock on this list. The first company that reports earnings this week is a high growth stock, which is ticker symbol JD, which is JD.com, currently around $62 a share, up 109% on the 12-month chart, which is absolutely incredible. 1 year ago, shares were being traded around $30, up over $62 a share currently. So this is a Chinese e-commerce brand. They operate a global Chinese e-commerce platform that sells products all across the country. And of course, China is one of the most populated countries in the world, so they have an extremely large market to sell to. This company, of course, has seen beautiful share price appreciation, but that has been followed by their insane earnings reports. So 5 years ago, this company brought in $27 billion of revenue. Meanwhile, in the past 12 months, they brought in $85 billion. So each and every year, they're seeing insane share price appreciation over the long term. So this is a company that has generated a massive amount of revenue. E-commerce and the entire e-commerce sector has been growing rapidly. And this is a company that has seen that insane surge and may continue to grow each and every year. So of course, when a company is on a run up of 109% in 12 months, they are trading at their all-time high, you might want to look for a nice dip. So if earnings season actually leads to a dip in the share price, you may meet a nice buying opportunity for JD. Moving on, the second company to take a look at is one of the most well-established brands in the world, Walmart, ticker symbol WMT, at $132 a share. So Walmart reports earnings this week as well. And of course, Walmart is one of the retailers that actually remained open during the economic shutdown. So Walmart has continued to generate revenue throughout this whole pandemic, and I do believe this company will continue to grow long into the future. So on the 1 year chart, they're up close to 25%, 5-year chart up 83%, and they are very consistent on the 10-year chart up 163%. So very nice long-term share price appreciation with Walmart. So we all know Walmart generates the most revenue out of any company on the American Stock Exchange. They bring in over $500 billion of revenue each and every year. Of course, Walmart does have low margins. They don't bring in a lot of net income, but their revenue is insane. So Walmart, I do believe, has some nice growth potential moving forward because they're coming out with a rival to Amazon Prime. They are coming out with their own platform called Walmart Plus, which will offer same-day delivery for a bunch of products, which may be a nice addition to their overall portfolio and could, kind of steal some customers back away from Amazon. So I think Walmart is an interesting company this week, and with their latest earnings report, if we can see some price movement, it may be a nice time to start or add to an existing position. Walmart is a dividend-paying stock, yielding 1.63%, sustainable 42.8% payout ratio, so a lot of room to continue to pay out that dividend and grow operations, with a very slow 5-year dividend growth rate of only 2%. So they aren't really raising that dividend to beat inflation. They're kind of just matching inflation each and every year, and they've been growing that dividend for 47 years. So they're almost a dividend king, and I'm almost certain that they will continue to pay out that dividend and grow it for 3 more years to reach that dividend king status. But of course, with Walmart, slower yield, slower dividend growth, but you are getting some pretty nice share price appreciation each and every year. And with regard to dividend safety, their dividend safety rating is at 78, so their dividend is considered safe, very unlikely that it gets cut anytime soon. And one thing to point out with Walmart, they have a very low beta of 0.51, so not a lot of price volatility on the daily stock chart. So if you're looking for a company to reduce the overall volatility of your portfolio and you want a low beta company, Walmart may be one you want to take a look at. The third stock on our list today is another retailer. It is Home Depot. This is another retailer that actually stayed open for a large part of the pandemic. They did shut down briefly, but overall their stores did remain open because they are considered essential. People still need their supplies in order to make upgrades to their home, and of course, construction and other different contractors use Home Depot on a daily basis. So they are being traded at $280 a share, up close to 40% on the 12-month chart. You can see they saw March lows, but have fully recovered and continued to grow. A 5-year chart, they're up 134%, so beautiful long-term share price with Home Depot. This is another dividend-paying company, and this is another retailer that operates, of course, within the consumer brand, And this is a type of company that there aren't many competitors. Other than Lowe's, which also reports earnings this week, Home Depot and Lowe's are kind of the two companies that operate as duopolies in their type of segment, and not a lot of companies can directly compete with how large the size of these companies really are. So Home Depot pays 2.14%, very sustainable 56% payout ratio, and they have insane dividend growth of around 23.7% average over the past 5 years, which is absolutely incredible. They've done a beautiful job of growing that dividend by an insane amount each and every year. So of course with Home Depot, you are getting that share price growth. And even though the starting yield may be somewhat low at 2%, they are growing that dividend rapidly each and every year. And they have an 11-year dividend growth streak. They have a very safe dividend with a dividend safety rating of 87. So once again, this is a company that is very unlikely that they cut their dividend anytime soon. Stock number 4 is a high growth stock that does pay a dividend, and it is Nvidia. So this is a semiconductor company that has been on a tear over the past 12 months, up 208%. So they're currently being traded at $462. 1 year ago, shares were around $150 a share, up to $462. So absolutely insane growth from Nvidia. So this is a company that if you're looking to get into the semiconductor space, which I believe has a lot of potential moving forward, this is a company where if we see a dip this quarter or this week because of their earnings reports, or we see any type of dip, this is a company that I have at the top of my watch list and I will probably be buying this week if there is a nice opportunity. This is a company that has a very strong fundamental backing, and I do believe this company will continue to grow very nicely into the future. They do pay out a slight dividend, very little, almost zero, at 0.14% yield. That dividend is almost nothing. Their annual payout is 64 cents per share, and you're buying a share for $462. So it's absolutely crazy how low that dividend yield is. I really don't even count this as a dividend paying company, but I do have to show it off because they do pay out a yield. Their payout ratio is below 8%. So they are paying out almost none of their earnings. They're keeping so much earnings back into the business. 92% of their earnings are staying within the company to be reinvested in grow operations. And of course, they have been growing that dividend at a very fast rate of around 13.5% average over the past 5 years. Because of their low payout ratio, that high dividend growth rate, I believe, will continue to happen. And they've been growing that dividend for 7 straight years. They have a very safe dividend at 89. This dividend I do not believe will get cut anytime soon. And Nvidia is definitely a company I have at the top of my watch list this week that I do plan on adding to my position. I do own a small position in Nvidia already, and I do believe I'm going to add to this position this week if I find a nice buying opportunity. Next stock on our list is Home Depot's biggest competitor, which is Lowe's, the other home improvement brand on the market. So this is a stock that's been around for a long time and has seen an insane share price growth over the past 1 year, up 64%. This is a company that's continued to grow, and similar to Home Depot, they were maintained operations for a good part throughout the pandemic, and they operate in a segment that, like I mentioned, there's only Home Depot really as a completely direct competitor. Of course, they offer products that are sold in other smaller stores, but Home Depot is their main competitor. And this is a company that has proven to continue to grow and continue to grow operations each and every year, up 65%, which is almost insane to even think about on the 1 year chart. 5 year perspective up 114%. So this is a company that I believe if we can see a dip in price because of earnings, is another nice addition to your portfolio, because I don't believe Lowe's or Home Depot are going anywhere anytime soon. And those are those household brands that are going to stay within the market and continue to operate for years to come. Lowe's is a dividend king. They've been growing their dividend for 56 consecutive years, which is absolutely incredible. They are yielding 1.43 dividend yield right now with a payout ratio of 30%. So a very sustainable payout ratio of only 30%. Very unlikely that that dividend gets cut anytime soon. They have a lot of money to continue to grow the business, sustain operations, and it's amazing to see that this company has been growing their dividend for 56 straight years and can still maintain a sustainable payout ratio, lower starting yield, but they are growing that dividend at over 20% per year over the past 5 years, which is absolutely incredible. So this is a beautiful company to look at. They have nice share price appreciation. Your starting yield may be lower, but that yield is growing rapidly each and every year. They have a sustainable payout ratio, and they have that strong dividend history of growing their dividend. So Lowe's is very attractive to me. And if we take a look at their dividend safety rating, 93, very safe. Extremely unlikely that Lowe's cuts that dividend anytime soon, and I do believe they will continue to pay it out and continue to grow it each and every year. Stock number 5 this week is Alibaba, ticker symbol BABA. $254 a share. This is another Chinese e-commerce platform. And of course, e-commerce is a sector that has been on a tear right now. And I do believe it will continue to grow. And this is a company that will see that benefit moving forward. Up 56% on the 1-year chart. A lot of these stocks this week have been on insane run-ups. So hopefully during this week of earnings, if earnings, don't beat expectations or they aren't as good of a surprise as expected, they may see a nice little dip in share price and we can get into these solid companies. So this is a growth stock. They do not pay out a dividend, but up insane on the 1-year chart. Longer term view up 240% on the 5-year chart, which is absolutely incredible. This is one of the largest e-commerce platforms in the world and actually one of the largest companies in the world by market cap with a $686 billion market cap. This is one of the largest companies in the world. So Alibaba, dominant brand in the e-commerce platform, and I do believe they will continue to grow. If we take a look at their income statement, you can see rapid growth year over year. Total revenue in 2016 at $15 billion. 2016, $15 billion. Trailing 12 months, close to $72 billion in total revenue, which is absolutely remarkable. If you think about that, 5-time revenue growth in a matter of about 4 to 5 years. Absolutely incredible to see. And this company brings in insane net income each and every year. $72 billion in revenue, and in the same 12 months, they brought in close to $21 billion of net income. So extremely high profit margins. This company is bringing in huge amounts of net income each and every year, and I do believe this company will continue to grow their operations very nicely into the future. The last stock on our list today, the 7th and final stock, this is the most speculative of the stocks we talked about today. This company has been hit extremely hard by the pandemic, and it is Footlocker, ticker symbol FL. They report earnings this week, and of course, with malls being closed, they could not operate a large part of their business, and this stock has been hammered. 1-year chart, they are down 24%, currently being traded around $28.73. This is the one company that I have an eye on, but I'm not too dedicated towards. They do report earnings this coming week, and I will be staying tuned for that earnings report. But this is a company I had to include because it is a well-known consumer brand. Malls are starting to reopen again, and people are starting to, spend some money and go out shopping. So Footlocker may see a recovery. This is a company that got hit extremely hard. Huge share price decline. They did suspend their dividend, so they are not paying this 5.56%. That dividend has been cut. No dividend payment coming from Footlocker. Huge crash with that company. So I did have to talk about them because they are reporting earnings this week, but this is the most speculative of the list today. The first 6 companies we know well more, like blue chip established brands that I do believe will continue to grow without issue. Footlocker is a company that we'll have to watch to see if they're what their plan is to continue to grow and bring back revenue, and we'll see what happens moving forward. So those were 7 stocks you can take a look at this week. All 7 of these companies report earnings. If you're interested in adding to any of these positions, take a look at that earnings report. See if there may be a nice, buying opportunity if you believe in what the company reports, or if you want to try to, play the earnings game and buy before earnings. Do whatever you need to do. None of these are financial recommendations. These are just stocks you should take a look at that are reporting earnings this week. So thank you for watching, everyone. I'm the Gen Z Investor, and we'll see you in tomorrow's video.